We all hear about the snowball effect and compounding. Invest, reinvest, let time do the work. But there's a detail that usually gets skipped. Charlie Munger put a number on it. Get your hands on $100,000 however you can, and after that, you can ease off the gas. Well, the problem is obvious. Most people don't have $100,000 lying around. So the real question becomes, how small can you start and still get the dividend snowball rolling? In this video, I'll show you why the start feels so slow and what actually changes around $100,000 and the 5 stocks John uses to build this. And in the end, I'll show you the 2 lowest amounts that make the compounding work to reach a portfolio valuation of around $1.5 million, paying over $5,000 in monthly dividend income. One is the lowest one-time investment you need to make it work, and the second is the lowest daily contribution. Now, the ending is the fun part. The beginning is often the part that makes people quit. Look, nobody wants to hear about patience when the balance isn't moving, but that's the part that actually breaks people, so it's worth sitting with for a minute. Here's how it goes. You save up some money, you put it in, you turn on reinvestment. Then you check the account a few weeks later. Well, months if you're being honest with yourself, and it looks almost exactly like it did when you started. The snowball does work at any amount. $100 compounds. It just doesn't do anything you'd notice for a very long time. Let me show you. Let's put some real numbers on it. Say you've got $10,000 invested at a 5% dividend yield. Yield is just the share of your money that comes back to you as dividends each year. So 5% on $10,000 is $500. Now, dividends do grow. Say these ones grow 10% a year, which means the same shares pay you more each year without you lifting a finger. So year 2 comes in at $550. $50. That's your raise spread across 12 months. And here's where the snowball part gets a little uncomfortable. You take that first $500 and buy more shares with it, which is the whole mechanism. Dividends buy shares, those shares pay dividends, and round it goes. Your new shares pay 5% just like everything else, which is $25 a year. That's what an entire year of reinvesting bought you. $25 arriving annually. $2 a month. Yeah, you don't feel that. It doesn't change how you live, and it definitely doesn't make you want to do this for another 29 years. But be stubborn. Keep going anyway, because nothing here is actually wrong. There's no mistake to fix and no better strategy hiding somewhere you haven't looked. The system is doing exactly what it's built to do. It just has no weight behind it yet. And that's the piece people get wrong about compounding. It runs on size more than it runs on time. Time only multiplies whatever size you've already got. So while the base is small, the growth stays small. And there's honestly no clever way around that. You can't strategize your way out of not having enough money in the account. Get the base big enough, though, and it starts moving with you. So the waiting only pays you back once the portfolio grows into a certain size, and you can actually watch where that happens. $100,000 growing at 8% a year. After 10 years, that's $215,892. Decent, nothing you'd retire on. Give it another 10, and it's $466,096. Steady progress, still not dramatic. Now let it run one more decade. Same money, no new deposits, no better strategy. It lands at $1,006,266. The last 10 years did more than the first 20 put together. And the growth rate swings that entire number harder than people expect. Drop it to 6%, and 30 years leaves you with $574,349. Push it to 10%, and the same $100,000 finishes at $1,744,940. 1% here, 2% there, over 3 decades, that's $1 million spread. And you can see the same shape in that $100,000 example from earlier. First decade, it adds $115,892. Second decade, $250,204. Third decade, $540,170. Each 10 years does about double what the 10 before it did, and nothing changed except how much was sitting in there at the start of each decade. Which is why starting your investing journey earlier usually beats starting bigger. Time does the expensive part of the work, and it's the one input you can't go back and buy later. So the whole thing hinges on getting the base to a certain size. And that size has a number on it. Munger's number was $100,000, and he wasn't being poetic about it. He described the whole thing as rolling a snowball down a long hill. It's slow at the top, but near the bottom, you couldn't stop it if you tried. Here's what's actually happening at that level. Go back to that 5% yield from earlier. A $25,000 account pays you about $1,250 a year. Real money. Also easy to ignore because it doesn't change anything about how you live. Take the same account to $100,000 and it pays $5,000 a year. That's the year the reinvestment starts buying a serious chunk of new income, and that new income turns around and produces income of its own. So think of $100,000 as the handoff. Below it, you're the engine, and pretty much every dollar of progress is a dollar you personally put in. Above $100,000, the account takes over most of that pushing. And to be clear about one thing, compounding doesn't switch on at $100,000, it starts at $1. What changes at $100,000 is that you can finally see it happening. There's a fair objection here too. Munger said that 30 years ago. And inflation would now put this number close to $200,000 today. Fine, the price tag moved. The mechanism underneath it didn't. Now, in a couple of minutes, I'm going to show you the lowest daily or one-time amount John needs to get himself across that line, and then keep going until he's sitting on roughly $1.5 million, paying him over $5,000 a month. But how fast he gets there depends on something underneath all of this. And it's the part people skip past when they're picking dividend stocks. What's a dividend actually worth to you in 20 years? Because the number on the screen today really doesn't answer that. Yield tells you what a stock pays right now. Dividend growth tells you what it'll be paying when it matters. A high yield feels good. The cash shows up, it's immediate, it's satisfying. But if that payment barely moves over 2 decades, inflation eats it from underneath while everything around it gets more expensive. Dividend growth runs on a different clock. It hands you less today and commits to more every year after that. Each raise builds on the last one, and the dividends you reinvested are buying shares that get those raises too. This doesn't mean yield is bad. Yield helps you get started, but growth decides how far you go. And for that to work, the businesses behind those dividends have to be strong enough to keep raising them, which brings us straight to the checklist that actually matters when you're building a portfolio meant to compound. John's 3 rules for selecting these stocks are boring on purpose. 1, a long history of paying and raising dividends. 2, a payout ratio under 70% so that there's room to keep raising. Earnings that actually grow, since dividends come out of profits. And 3, low turnover, so he isn't making decisions he'll regret in a bad year. Based on these criteria, John narrows it down to 5 stocks. The first one is SCHD, an anchor for his portfolio. And what makes it useful is that it runs John's checklist for him. To even qualify for the index this fund tracks, a company needs 10 straight years of paying dividends, and then it gets screened on debt coverage, return on equity, and how fast the dividend's been growing. About 100 stocks survive that test. It costs $6 a year for every $10,000 you hold. SCHD yields 3.15%. Its dividend has grown 10.24% annually over the past decade, and the share price has appreciated 8.82% a year. ABBV is here because of a stress test it already passed. AbbVie split off from Abbott in 2013 and has raised its dividend every single year since, going from 40 cents a quarter to $1.73. Somewhere in the middle of that run, Humira, which was basically the entire company, lost patent protection and sales fell off a cliff. The raises, however, never stopped. Skyrizi and Rinvoq picked up the slack, and the revenue's climbing again. You get 2.67% today, dividend growth of 11.89%, and 14.94% annual appreciation. Lowe has paid a dividend every quarter since Lowe's went public in the 1960s, and the most recent raise landed while the CEO was calling this the hardest housing market he'd seen since the financial crisis, with housing starts down 15% in a single month. Well, they raised anyway. Payout ratio still sitting in the low 40s. Lowe's brings a 2.41% yield, 15.09% dividend growth, and 9.86% appreciation. AGM you've probably never heard of, Federal Agricultural Mortgage, created by Congress back in 1988. It's more or less Fannie Mae for farmland. It buys agricultural mortgages off local lenders so that those lenders can turn around and write more loans to farmers. Unglamorous work, and it just posted its 10th consecutive year of record core earnings on $33.4 billion of business volume. The dividend has gone up 15 years running. AGM carries the fastest dividend growth in this portfolio at 22.13%, alongside a 3.05% yield and 18.48% annual appreciation. Next up is UNH. And John knows what you're thinking here. United Health got hit hard in 2025, genuinely hard. But remember, the part that matters for a portfolio like this one is that the dividend went up anyway. 16 consecutive years of increases now, straight through the roughest stretch the company's had in decades. The numbers land at 2.21% yield, 15.46% dividend growth, and 11.5% appreciation. Run all five together at equal weight, and the portfolio settles at a 2.7% dividend yield, a 14.96% dividend growth rate, and 12.72% average annual appreciation. And that middle number is what turns a small starting amount into something worth waiting for. So that's the portfolio sorted. What's left is the money going in, and there are two completely different ways to do that. And the one you use comes down to a question you can answer in about 3 seconds. Do you have money sitting around somewhere doing nothing right now? Some people do. A few thousand in savings, maybe an old account nobody's looked at, money that's been parked for years earning almost nothing. If that's you, then the first path will be yours. Some people don't have any money just lying around and never really have, but they can move a small amount every day without feeling it. If that's you, the second path will be yours. Both land at $5,000 a month, they just get there differently, and the difference between them says something useful about how this whole thing actually works. So let's take the first situation. The money already exists. It's just sitting somewhere doing nothing. For this, the lowest one-time investment you need is $15,000. John puts it in, turns on reinvestment, and never adds another dollar. After 12 months, the portfolio is projected to sit at $17,313. By year 5, it reaches $30,888. Still small, still deep in that stretch where nothing looks like it's happening. Year 10 lands at $64,519. Then year 13, which is the one that matters, $101,134. That's the line Munger was talking about. Everything after this point moves faster than everything before it. Year 20 is projected at $295,816, and by year 30, it reaches $1,468,020, paying $63,927 a year in dividends. That works out to $5,327 a month. Of the $1,453,020 the portfolio adds across these 3 decades, roughly $1,069,437 comes from share prices rising, and about $383,583 comes from the dividends he kept reinvesting. Now here's the part worth sitting on. In year 22, John's portfolio is projected to pay him $14,866 in dividends. He invested $15,000 total. So think about that. That single year, in year 22, of dividend income comes up just $134 short of everything he ever put in. Then year 23 pays $17,785. 1 year of dividends worth more than his entire starting investment. And he's still got 7 years left to run. But of course, all of this assumes John has $15,000 on hand in the first place. Plenty of people don't, and that changes the question completely. So John runs the whole thing again, except this time he starts with nothing, zero, and instead contributes $7 a day. End of year 1, he's got $2,555 in the account, which is precisely what he put in there. Nothing else has happened yet. Year 5 reaches $17,433. Year 10 lands at $53,963. And around year 13 and year 14 is where he crosses the $100,000 line. But there's a different moment on this path, and it's more interesting than the threshold. Watch year 12. John puts in his usual $2,555. That same year, the portfolio pays him $2,245 in dividends. He's still ahead, putting more in than the income is paying him, but barely. Year 13, the portfolio pays $2,756. That's the year dividends give him more than he puts in. And the gap continues to widen after that. By year 20, the portfolio is paying $10,589 annually on a $303,441 valuation, while John is still handing over the same $2,555 every year. By year 30, it's projected to reach $1,564,576, paying $68,021 a year, which is $5,668 every month. Now compare what the two paths cost him. The one-time path used $15,000 of John's money, total. The daily path used $76,650. Both cleared $5,000 a month. The lump sum needed less cash because it had all 30 years working on it from day one, and the daily path had to make that difference up in deposits, which is the same thing the decade math showed earlier. Time is the cheaper input. If you've got it, you need less money. If you don't have the money, you make it up with consistency. Neither one is the smarter play. They're simply answers to two different situations. Now, what if you don't have 30 years? I ran the same math on the fastest way to get to $5,000 a month instead of the cheapest. That video is on screen right now.